Let's be real for a second. If you've ever tried to look into investing, you've probably run into a wall of jargon that feels like it was designed to keep you out. You hear people talking about diversification, asset allocation, and expense ratios. And honestly, it's enough to make you just want to keep your money under your mattress. But then you hear this one term over and over again: mutual funds. It sounds official. It sounds like something your parents' accountant would talk about. But what actually is it? Is it a stock? Is it a bank account? Is it a scam? Today, we're going to strip away the suit and tie nonsense. I'm going to explain exactly what a mutual fund is, how it works, and more importantly, why it's probably the single most important tool for a regular person to build actual wealth without losing their mind. To understand a mutual fund, forget about the stock market for a minute. Think about a potluck dinner. If you wanted to host a massive feast by yourself, you'd have to go to the store, buy 20 different ingredients, spend 12 hours in the kitchen, and pray that you don't burn the steak. It's expensive, it's risky, and it's a ton of work. That's like buying individual stocks. You have to research every company, watch the news 24/7, and if that one company fails, your whole dinner is ruined. Now, think about a potluck. Everyone brings one dish. One person brings the salad, another brings the chicken, someone else brings the dessert. You put all those dishes on one big table. Now, for the price of just one dish, you get to eat a little bit of everything. You have a full, balanced meal. And if the guy who brought the potato salad totally messed it up, it doesn't matter because you still have 19 other delicious dishes to eat. That is a mutual fund. A mutual fund is essentially a giant pool of money collected from thousands of regular investors like you and me. A professional fund manager takes that massive pile of money and buys a basket of different investments, stocks, bonds, or other assets. When you buy a share of a mutual fund, you don't own the companies directly. You own a piece of that basket. The beauty of this is something called diversification. This is the don't put all your eggs in one basket rule. If you take $100 and buy one share of a random tech company, and that company has a bad year, your $100 could turn into $50 overnight. But if you put that $100 into a mutual fund that owns 500 different companies, and one of them goes bankrupt, you'll barely even notice because the other 499 companies are still there, working for you. Now, you might be wondering, who decides what goes into the basket? This is where it gets interesting. There are generally two types of mutual funds you'll run into. The first is actively managed funds. This is where a fancy fund manager in a high-rise office, someone who went to an Ivy League school and wears a $2,000 watch, tries to beat the market. They pick and choose exactly which stocks to buy and sell every day. They're like a chef at a restaurant trying to make the perfect meal. Because they're doing all this work, they charge you a fee, which we call an expense ratio. The second type, and this is becoming way more popular, is passively managed funds, often called index funds. Instead of a fancy manager trying to be a genius, these funds just use a computer to track a specific list, like the S&P 500, the 500 biggest companies in the US. It's like saying, I don't want a chef to guess, just give me a little bit of everything on the menu. Because there's no high-paid manager making daily decisions, the fees are incredibly low.
Now, let's talk about the how. How do you actually make money with these things? There are 3 ways a mutual fund puts money in your pocket. First, income. If the stocks in the fund pay dividends or the bonds pay interest, the fund distributes that money to the investors. It's like getting a small thank you check just for owning the fund. Second, capital gains distributions. If the fund sells some of its stocks for a profit, they pass that profit on to you. And third, net asset value increase. This is the simplest one. If the value of all the stocks in the basket goes up, the price of your share of the fund goes up. You buy it at $50, and a few years later, it's worth $80.
But I have to be honest with you, mutual funds aren't perfect. There's no such thing as a magic money tree. The biggest gotcha with mutual funds is the fees. Even a small fee, like 1% or 2%, might not sound like much, but over 20 or 30 years, that fee can eat up a massive chunk of your potential wealth. It's like a slow leak in a tire. You won't notice it on the first mile, but eventually you're going to be driving on the rim. This is why I always tell people to look at the expense ratio before they buy. Anything over 1% should make you ask a lot of questions. Another thing people worry about is control. When you buy a mutual fund, you're giving up the steering wheel. You can't call the manager and say, "Hey, I don't like Apple, sell their stock." You're along for the ride. For some people, that's scary. For most people, including me, that's actually a blessing. It stops us from making emotional, stupid decisions when the market gets volatile. So, why should you care about this right now? Because the middle-class squeeze we've been talking about is real. Inflation is eating your savings. If you keep your money in a standard savings account at 0.01% interest, you are effectively losing money every single day. A mutual fund is the great equalizer. It allows a guy with $50 to invest in the same companies as a billionaire. You don't need to be a math genius to start. You don't need to spend hours looking at charts. You just need to understand that wealth isn't built by working harder. It's built by owning things that grow. If you're a beginner, here's my advice. Don't try to find the hottest mutual fund of the year. Don't chase the one that grew 50% last month. That's usually a trap. Instead, look for a total market index fund with low fees. It's boring. It's not going to be an exciting conversation at a cocktail party. But boring is what gets you retired. Boring is what pays for your kids' college. Investing is a marathon, not a sprint. A mutual fund is like a high-quality pair of running shoes. It won't run the race for you, but it'll protect your feet and keep you moving forward when the ground gets rocky. Before we wrap up, I want you to do one thing. Check your retirement account if you have one, like a 401k or an IRA. Look at what you're invested in. Chances are you already own some mutual funds and didn't even know it. Look at the fees. Look at what's inside the basket. Knowledge is the only thing that kills fear in the stock market. Once you realize that a mutual fund is just a group of people pooling their resources to own a piece of the economy, it stops being scary and starts being an opportunity. The best time to start was 10 years ago. The second best time is today. Don't let the jargon keep you on the sidelines. Get your dish to the potluck. Start small and let the power of the global economy do the heavy lifting for you. Thanks for watching. If this helped clear the fog a little bit, hit that subscribe button. We're going to keep breaking down these complex topics until the system doesn't feel so rigged against us anymore. What's the one thing about investing that still confuses you? Drop it in the comments. I read them all, and your question might be the focus of the next video. See you in the next one.